Hi, everyone, and welcome to this event hosted by the Work on Climate community as a part of our Climate Investor series. For any attendees who are not familiar with Work on Climate, we are a nonprofit focused on making climate work mainstream. We are home to the world's largest climate community, where we support people with events such as this and mentorship programs as well. You can come join us at workonclimate.org. My name is Utkarsh Vaidya, and I lead the events team for Work on Climate. But I'm also the CTO at Ilaniti, which is a pre-seed climate venture in the regenerative agriculture space. Because of our own recent efforts on fundraising, I know how complex the climate tech VC space can be. And one of our main objectives at Work on Climate is to create educational content to help demystify the climate VC ecosystem and make it more accessible for job seekers and founders. So it is my pleasure to introduce Kim Zhou to help us understand the current state of climate VC. Kim is the co-founder of Climate Tech VC, which is the leading resource covering the intersection of climate and innovation with 30,000 plus weekly readers. Climate Tech VC generates data-driven insights on the climate tech market and highlights leading companies and voices working to bend the climate curve. Kim was previously a climate tech investor at Energy Impact Partners, a venture capital firm with over $2.5 billion in assets under management. Prior to joining Energy Impact Partners, Kim was also a part of JPMorgan's Tech M&A investment banking team and graduated from Johns Hopkins University. Welcome, Kim.
Of course, thanks for the intro. I guess we covered most of it here. I'm Kim. Great to meet and see you all. Excited to jump in, as I'm sure you're all curious about the climate tech venture funding market. To add some more color to that introduction, started my career off in banking and then spent the next few years in venture at Energy Impact Partners. So had a pretty unique model where we worked really closely with a coalition of the key stakeholders in the energy transition, including utilities, real estate companies, transportation companies. And through my time there, kind of got to see firsthand what it was like to be investing in this space, some of the challenges, especially in kind of the energy world. And then along the way too was running and writing CTVC, and actually left 2 months ago to do that full time. So will be some more exciting updates there, hopefully. And the mission of CTVC, which I can kind of cover quickly here for those who don't know us, is really to fill this information gap when it comes to climate tech. So I started it at the beginning of 2020, before climate tech had really emerged as the new phrase, the new word we're calling this new wave. And for me, it was really, the genesis of it was really because I myself was curious, what is climate tech? What are deals happening in this space? What are companies in this space? As that conversation started to pick up. And so in my free time was tracking what was going on, started doing that through the lens of CTVC, the newsletter, which is on the left-hand side here. So really cover all the deals, all the news in a newsletter delivered every single Monday, as well as highlighting key kind of headlines and trends related to climate tech. And over the last few years, we've been going even deeper. So in addition to just covering what's happened, we also cover how to think about it. How do we dive deep into these sectors, the technologies that make up climate tech? So we've published things ranging from battery value chains to ruminating on enteric emissions, different seaweed-based supplements to actually mitigate enteric emissions, all the way to supply chain traceability, sustainable seafood. So kind of span the broad different sectors of climate tech, as well as diving deep into funding insights and trends and things like that. And then we also have highlighted various innovators and investors. We, on Friday, published an interview with Rob Hansen from Monolith Materials, which was really, really exciting to chat with him since they've kind of seen the whole scope of the climate capital stack and are really far along in their journey. And then finally, we track who the players are in this space from the capital perspective. So we have a running list of the kind of most active climate VCs. We have a running list of corporates who are really engaged in this space, as well as accelerators and incubators for those who are kind of starting their entrepreneurial journeys. And so that's the broad landscape of CTVC today, really seeing ourselves as the go-to resource on climate innovation. We have more than 30,000 subscribers, majority of which are investors, corporates, and operators. I'm sure some of you on the call hopefully are subscribers as well. And yeah, we'll be continuing to build off where we are today. So look out for more to come. But I thought it'd be fun to we I think a week ago released our mid-year funding report. So in real time updated on what's happened in the first half of 2022, which I think is extremely relevant, especially given where the market has the overall macroeconomic market has kind of gone over the last few months. So I personally was really curious to also see how that data has kind of trended across climate. So I can walk through quickly some slides here, which we have in the report, and provide some kind of thoughts, but would love if you all have questions or thoughts or insights, just feel free to like raise your hand and jump in and go off mute or whatever. I want to make this super interactive. So just quickly, I mean, I'm sure most people on the call know what climate tech is, hopefully, and what the sectors are, but quickly going over like the taxonomy in which we've framed the world. So I think about this in 7 broad buckets, 7 broad verticals: energy, being one of them, clean power generation, distributed energy resources, hydrogen, as well as, food and land use, transportation, the built environment. So those are kind of industrials as well. So those are kind of like 5 key verticals in which we need to decarbonize our society and really focus on mitigation. And then there's also the kind of impact lever of carbon removal and management. How do we remove existing atmospheric emissions, or how do we, and for climate management, how do we actually think about adaptation or monitoring? How do we understand our world as it is today in terms of the amount of emissions we've put into it and what the effect will have over time, as well as start to develop, intelligent solutions to better, come up with mitigation strategies, or even in the future, think about adaptation and what that would look like. So these are kind of the broad, 7 verticals of climate tech, which I could go into more detail, obviously, into how those are all made up. But it might be interesting to get right into the data. So here we've mapped out, how do these sectors actually?
Are you trying to share your screen?
Oh shoot! I just realized I'm not sharing my screen this whole time. There we go. Okay, so this is kind of the view of CTVC and what we're doing today. So that gives some more insight. And then these were the 7 sectors mapped out. So we go into a lot more detail at the subsector and even sub-sector level. But this gives you kind of a broad landscape of what are differing, climate tech solutions, what are different climate tech challenges, as well as, in the subsector level solutions that are specifically trying to address them. So I'll pause there for a little bit just so you guys can take a look. And then another view we really like to take is like, why does this matter, right? Like, why are we talking about climate tech? How does this actually map to the amount of emissions, the kind of emissions pie that we talk about? And so this is a view from the World Resources Institute, which is a bit confusing. We've gotten this question a bit, which is like, where is energy on this? How does that map to energy on the right-hand side? And that's because energy really makes up a lot of these key kind of segments like buildings, transportation, industry, metals, cement, fuel combustion. So it's kind of embedded into a lot of those key sectors. But we can see, food and agriculture still continues to be, near the top of that list, which correlates with the amount of deals in this space. And energy kind of fits into all of the above. And then this is another view by actual funding. So while the amount of deals has been most prevalent in energy, food, and water, the amount of funding has been most prevalent in mobility solutions. So things like transportation, things like micromobility, electric vehicles. And so while transportation does make up, the third kind of biggest piece of the pie, it continues to kind of take the cake in terms of amount of funding gone into the space. So always a little bit of mismatch, I think, relative to the amount of emissions impact in comparison to the amount of actual venture funding going into some of these sectors. And so what we've done is actually mapped out, this is a bit of like a market map breaking down those 7 key sectors of, what are the climate tech companies and solutions that we've tracked over the last 2 years. There's a lot of interesting back-end data to dig into here, but essentially high level takeaway, we tracked over the last 2 years, $70 billion of venture capital deployed in 1,140 companies across these 7 major verticals and more than 60 plus critical kind of subsectors. And you can see here that transportation, energy, and food kind of still reign supreme. So accounting for, 60% plus of the climate company count. And within this, you can also see that some sectors like alternative protein and foods actually make up almost 8% of that company count. So pretty significant when you think about the venture-backed companies here and where a lot of that activity has been focused. And this is the same kind of view, but from a dollars deployed funding perspective. And again, correlated to the view before, most of the dollars deployed have really gone into autos. So think, Rivian and the other kind of electric vehicles in the space, battery companies like QuantumScape. So I think some of the high level takeaways here is that this, Impossible Foods kind of Tesla effect in the public markets has really led to a disproportionate share of activity, especially probably during the early SPAC days of venture investment into, alternative proteins and electric autos. And so now we can start to get into what venture funding has looked like over the past 2 years, but specifically how that's trended in the last 2 quarters. And so in this view here, you can see in that Q1 and Q2 2022, startups raised about 18.6 billion in that first half of 2022, which represents a 21% decline compared to the second half of 2021, which I would say probably is around the peak of climate tech funding activity. So we are seeing a bit of air coming out of the market, I'd say, in climate tech from a dollars deployed perspective. And I think another interesting takeaway here is even though dollars deployed is declining, we've seen a bit of a diversification outside of transportation, energy, and food. So we're starting to see industries like carbon, climate management, and industry start to pick up in funding. And we'll go into why this is later, but one of the reasons for this overall decline in funding isn't necessarily because of an overall decline in deals activity, but rather a decline in really massive growth size rounds. So in 2021, we saw a lot of $500 million plus rounds driven by SPACs and other kind of new growth funds launched. Whereas here, I think we've seen that large cohort of funding trickle down a bit. So you can see here, we've actually had deals activity pick up. So aside from the overall dollars deployed market slowdown, the number of climate deals increased to 477 so far this year. So that represents a 76% increase to the first half of 2021 and 36% increase to the second half of 2021. So interestingly enough, even though the amount of funding has gone down, the deal activity has actually gone up. And the reason for that is because of this kind of like stage breakdown. So we've seen a 39% decline in growth or Series D plus funding, but a significant pickup in seed and Series A funding. And anecdotally, I think that's driven by the fact that we've seen the overall kind of climate tech market trend upwards in the last 2.5 years, and are starting to see more talent, such as I'm sure a lot of you in Work on Climate pick up, and more entrepreneurs wanting to this space, more kind of excitement at that super early stage and willingness to fund those types of companies, as well as I think a lagging effect in that overall earlier stage of the market. So market slowdown typically hits growth stage, late stage size deals first, whereas seed and Series A funding I think so far have been a bit more insulated from these broader macroeconomic slowdown for the time being. And we've shown a report as well on the amount of kind of climate dry powder that's still out there, which is around 20 billion, given the amount of new funds that have announced. So still a lot of available funding, I think, that will continue to insulate, especially the earlier stage of the market, where we've seen more deal activity pick up. And this is just another view that kind of shows that, right, of that kind of trend downwards in growth activity. And then we can see over here as well on the right-hand side that we've split actually the cohorts of these companies. So there's the 50 to $100 million round sizes all the way to above 500 million round sizes. And we've actually seen a pretty significant drop off where in 2021, more than that the $500 million plus deals actually made about 10% of this cohort, whereas now it makes about 2% of that overall growth cohort. So significant kind of drop off in those pre-SPAC, let's say, size rounds. And here's another quick view too on what that stage breakdown has trended towards in terms of different industries. So this kind of tells the story of the difference in maturity between verticals. From left to right, you can see the most mature to the least mature. And so clean tech 1.0 era verticals like transportation, energy, and even food and land use lean towards later stage deals. So more than 40% of that activity, it takes place in Series B stage or later. Whereas in emerging, more nascent markets like carbon management or climate risk and intelligence, more than 80% of that actually skews towards the seed kind of Series A level. So all of this kind of data is telling relatively the same story in different lenses, which is activity in some of these more nascent sectors like carbon and climate management, which are earlier stage in their maturity cycles, are starting to pick up, especially at that Series A level. Whereas more mature sectors like transport, energy, food, and land use, while still making up a majority, 70% plus of funding, are now starting to trend downwards a bit just because, growth, I think, opportunities in that 500 million plus segment have started to decrease with the market slowdown. Let me pause there because I just ran through a bunch of data. Let's see if you guys all have any questions or if anyone has any stories on the ground of going through some of these funding cycles themselves. Would be interesting to hear from the group, whether you all are seeing this from the investor landscape, the fundraising landscape, or just kind of seeing what's out there in the market. Okay, so I've gotten one question from Jean. Do we know what's responsible for that huge drop in funding from Q4 21 to Q1 22? That's a really good question.
Yeah, that was energy specific. I'm not sure if I actually mentioned that, Kim.
Yeah, you did. So I think what's interesting from the energy perspective, Q4 and Q3 of 2021 saw, I think, Commonwealth and Helion both raised $1 billion plus round sizes. So that alone really drove, I think, the significant kind of differential in energy funding, because both nuclear fusion companies raised about $3 billion alone in that one quarter. So that's where you kind of see that stark drop off. And again, like a lot of these deals and round sizes, even one or two of them can make a significant kind of like volatile trend in the funding number. Is this trend similar to non-climate tech VC sectors? That's a great question. And so we unfortunately don't track other sectors as closely, but in, I think, PitchBook and some other kind of like crypto funding has been tracked as well. So overall, PitchBook tracked a 23% drop in funding in the last quarter. So I think here it seems a bit more insulated. And then in crypto specifically, it was an even steeper 31% drop. So I think given the amount of funding decline, we're a little bit more, climate tech seems to be a bit more insulated versus the market. But interestingly enough, there's been a pickup in deals versus some of these other sectors. So many questions. This is great. Okay, what would be the driver of increase in seed funding? What drove the number of attractive ventures up? It's a good question. I mean, I can talk to this anecdotally, and I'm sure a bunch of you probably have some thoughts here as well. Anecdotally, my hypothesis is climate tech is still relatively new in the way that we think about it, right? Like we've been deep in this climate tech market for the last 2.5 to 3 years. And I think what happens is you see these different cohorts of companies coming out. So we had that initial cohort of companies that, the Monolith Materials of the world that's been at this for 10 plus years, had to kind of slog through this desert of clean tech 1.0 to get to where they are today. And so those are companies that had been kind of rearing, ready to go when climate tech activity picked back up. And then there's this new cohort of companies, entrepreneurs and founders who maybe came over from other sectors outside of climate tech and have now seen, the pickup of activity, the need for climate tech solutions, and are now starting to come to market and think through ways in which their skill sets can be applied to climate tech. And so I think we're seeing now that new wave, that new cohort of seed and Series A stage companies, of companies that have really arrived in the last year or so. I might have an interesting, this might be an interesting slide to talk to here as well, where you can see the gigacorns, the unicorns of climate tech companies. I think this was last updated in 2021. So there's definitely a few new unicorns as well, but you can see that those cohorts, right? At the bottom is the timeline in which they were founded. And then on the left-hand side, on the y-axis, you can see the years between their funding and reaching unicorn status. And so we're starting to see in the last 3 years or so, starting from 2017, that new cohort of companies that got started in the last few years that are now really, really quickly ramping up to unicorn status. So just get to kind of see that those cohorts of companies from the end of kind of 2008, 2009 clean tech 1.0 slog, all the way to the last 4 or 5 years that are in this new wave of climate tech. Okay, and then we can get to, let's do this geography. Here, let's do this slide really quickly, because I think this one would be interesting. This one is an interesting one to talk to about carbon specifically. I'm sure we've all been seeing it, in the news and in the headlines about how there's been this pickup in activity in carbon management and removal. And we've actually seen that in the data as well. And so we have a running joke that 2022 might just be the year of the carbon vertical, where we've seen, in the first half of 2022, carbon deal activity double over the same time from last year, and funding activities, so dollars deployed, actually 8x. And so that was really driven by, Climeworks' $650 million round, but also $100 million plus sides rounds from Carbon Clean, 12, Verdox raised an $80 million Series A, as well as Flow Carbon. So just a lot more kind of venture funding interest, I think, here, driven by announcements from Stripe and Frontier Climate on advanced market commitments and overall kind of corporate interest, it seems, in funding carbon removal and utilization. And then to your question on tracking these deals across all geographies, we have done that. So we often get the question, what does this look like in emerging markets? How much is taking place in just North America and Europe alone? And fortunately or unfortunately, however you look at it, together the US and Europe alone represent 80% of the climate companies we've been tracking. So to I guess maybe not many people surprised, most of this activity does seem to take place in North America and Europe, and California alone actually makes up about 20% of that total count. So it does seem like majority of climate tech still seems to be kind of centered in, developed market valley of the world. But Asia Pacific is making up a growing 10% of that. And so of that 10%, India and Australia make up about 6 to 20% of that respectively. And within those specific regions, we're seeing pretty interesting on the ground kind of climate tech solutions. So within India, a lot of solutions around battery swapping networks, as well as electric micromobility. That's really, I think, where a lot of that activity has centered. And then in Australia, have seen a lot of pickup in, battery mining companies, where a lot of the kind of industrial mining companies like Rio Tinto and BHP have proliferated. And then let's see. Here we've also tracked, what are the active investment firms by climate sector? So what trends are we seeing in terms of new fund formation? I think we have that at a later slide, but to here, it's who are the to the question of like, who are the investors that are playing in this field? We've tracked more than 2,000 investors. So 2,000 investors who have participated in at least one climate deal. We've branded them as the climate curious investors. But there's a portion of that, which you can see delineated by the kind of like white line underneath the zigzags, that are active, quote unquote, climate investors. So those are investors that have participated in at least 5 climate deals over the past few years. And you can see that in more nascent sectors like climate management or carbon that require perhaps a bit more of a, technically complex or niche understanding of those spaces, those active investors make up a higher proportion of that bar. But in general, that bar seems to be relatively stable across all those sectors. And so we've seen at least the general kind of similar amount of active climate investors across all of these industries, but a higher proportion of those active investors in more nascent industries. And I think, my running hypothesis for why we've seen so many, climate curious investors go into food and land and transportation and energy is because those sectors have been more mature and along for the ride for longer, but also because things like food and ag and alternative protein is easier for, climate curious investors to get involved with because it's something that we interact with every day. So things that are a bit more consumer facing that you can wrap your, head or mouth around seem to be a bit easier for climate curious or kind of like tourist investors to start deploying capital in. And so that kind of gets to Yuri's question, I think, on how do we see more VCs playing here and entering the space. We seem to see more climate curious investors first exploring food and ag and some of these more general climate sectors, and then the more senior kind of experienced climate investors then now starting to get into carbon and climate management and things like that. And so who are the VCs themselves? This is something we really actively track. So we have a running list on our website of the 200 most active funds, and that list is growing every day. We've seen, let's see if here we go. So we've seen over the last few quarters a variety, almost 100 new funds, I think, announced, ranging from really early stage venture capital all the way to large growth, almost private equity type of funds, representing at least $20 billion of investable dry powder. And we've done some back of the envelope map of what it would look like if they deployed consistently over the last 10 quarters. So still significant, I think, fund formation activity, which I think spells, relative insulation in climate tech compared to some other sectors, but still kind of something to note. And, these funds will have 2.5 to 3 year kind of timelines, and we'll have to deploy them no matter what. So I think even though the dollars of funding might go down over time, the high quality, companies will still get funded no matter what. And then quickly walking through the climate capital stack, which is something that we also track really closely. Venture capital is a small piece of the pie of the $9 trillion that McKinsey has estimated we need to fund every year. Last year, we tracked $40 billion of that as venture capital. So very, very small chunk. A lot of this needs to be, infrastructure funding, project finance, actual steel in the ground. And then a lot of this also has to be, public funding, which Jeff notably asked about. How much of this should be public funding rather than private? Actually, look out for a feature on that in the next few months on DOE and what they're working on, because that's really significant too, I think, in terms of the amount of public support that needs to go into this space. There's, as I showed earlier in that slide, a few key sectors that venture investors love to fund, like alternative proteins and EVs, those really, really kind of, sexy consumer facing sectors. But for the ones that require a lot more capital, require, 10 years of deploying pilots and demonstration, that's really where I think both, catalytic capital as well as public sector funding should and needs to come in to kind of get through those valleys of death. And so this is kind of another view of who those actors are. So in the pre-seed round, tons of diverse, actors that can facilitate that funding, but smaller check sizes. And then when you get to growth and later stage, also more kind of opportunities there in terms of growth, debt, project finance, LPO, as well as starting to partner with corporates corporates, big corporates who are looking to finance and pilot these things as well. And then finally, what's different this time? I think that's a question we always ask ourselves, right? Relative to Clean Tech 1.0, and especially I think relevant to this broader kind of macroeconomic backdrop. Why is climate tech insulated, or is it insulated? That's kind of a question I think we continue to ask ourselves. These are some general tailwinds. I think that really draws attention to why it is different this time around. The first is corporate pledges. I think we've moved on from believing that this is only kind of a public sector or public policy driven thing, and now private sector seems to be waking up and committing not only press releases but also dollars behind this. So we've tracked net zero pledges, but we've also tracked actual amount of capital that they've committed into the space, whether that's through new kind of advanced market commitments like Frontier Climate, where Stripe, McKinsey, Meta, and some of these other corporate players have committed more than $1 billion, or it's actual corporate venture funds. So lots of corporates like oil and gas majors, or even investment banks, industrial companies have started to commit their own climate corporate VC funds. Then there's the broader backdrop of ESG demand. I think like ESG has gotten to become a bit more of a controversial topic, but in general, a lot of this demand comes from, the LPs, the pension funds themselves, who are the ones investing into these funds. And now more than ever before, they're demanding some of these ESG type of returns and allocations, which then drives down to, the fund manager level, who are now going out and raising, ESG backed or climate relevant funds. And finally, climate policy, I think that's one we always go back and forth on. We just published a news headline on what just happened with Mention, so I won't spend too much time there because, bit of a maybe recently sore topic. And then I think the most relevant and unfortunate one today that we seem to experiencing more and more each summer is climate is tangible. It's no longer something that's 10 years down the road. It's not just knocking on our door. It's come into our house, so to speak. I was backpacking in Tahoe literally this weekend, and yesterday we had to leave early because of the Yosemite fire was coming in, and there's haze everywhere, and the air quality was over 300. And so I think this is starting to galvanize not really necessarily investor interest, but I think the tailwind here is more that it's driving really, really impressive talent into this space. And that's where we're starting to see this impressive cohort of early stage companies and entrepreneurs who are coming in that investors are excited to back and fund. And overall more attention, I think, paid from the private sector level as well, because they're seeing this less as a, this is more of it's becoming more and more near term from a climate risk and resilience perspective. And then finally, I think the key point that a lot of people kind of poo-poo from Clean Tech 1.0 and it being a bust is that actually Clean Tech 1.0 was a key driver for all of this, right? So we are now able to achieve these fundamental technology advances in solar and wind and get to cost parity with coal, which drives a lot of the second to third order effects of climate tech, of being able to develop green hydrogen solutions or develop direct air capture solutions that are driven off of these really, really cheap costs of electricity. And so without Clean Tech 1.0, without getting to that initial foundation of really cheap electricity costs, renewables costs, we wouldn't be able to, achieve a lot of these second order kind of climate tech solutions that we are working on today. So I think that's an important point that a lot of people might miss in Clean Tech 1.0 and is kind of a core driver of why I think we can have this new wave of climate tech. And so that's kind of the general, mid-year update, which you can also read in our report. Here are a bunch of other resources that we have put out, as well as other resources that are great to reference in climate tech as well. But yeah, I went over the 30-minute allotment. That's kind of a quick view of what we've been working on. And if any of you are curious to learn more about some of the research and intelligence we're working on in the back end, happy to chat about that offline.
Thanks, Kim. That was very insightful. I have a couple of questions for you, but for the audience, feel free to put your questions into the chat as well, and we can get around to them. But I have a more of a personal question for you. What prompted you to work in climate?
Yeah, it's a good question. Let's see. The kind of cheesy story I tell is back right before 2012. I remember when everyone thought the world was ending. I don't know if I really believe that, but I remember seeing all the, this documentary on like all the hurricanes and different natural disasters that were going to happen in 2012. And that was terrifying. And then I started to learn about climate change and realize, this is no longer a myth that the world is ending. Like these things can happen and will happen if we don't do anything about it. And so that started to be, I think, the genesis of my focus in climate. And then from there, have been spending really all of my time in it. Went from starting a sustainability hackathon to starting CTVC and things like that. So have always wanted to work at this intersection of climate innovation and finance.
Yeah, and you mentioned this idea of how insulated is the climate VC space compared to the general VC space. Since you speak with a lot of climate tech venture capitalists, I was wondering, what is the overall sentiment that you're picking up from these folks? Any interesting takes or perspectives that any of them have shared with you that kind of stuck with you?
Yeah, I mean, I think there's definitely trends here that are similar to what we're seeing in the macro market. It is venture after all, and it is, it follows kind of the headwinds and tailwinds of the overall public market, although lagging in some shape. So anecdotally, we've seen valuations are going down, but it does vary a bit depending on stage and sector. So I'd say similar to other sectors in venture, ones that have ones that have less kind of capital requirements are still getting funded and still kind of retain higher valuations, but hardware and more tech risk related ones seem to be going down and getting more measured in terms of amount of funding and valuation. There's also been, I think, more seed extensions, especially for founders who have just raised or from investors who kind of want to support their companies without having to go out into the market and try to raise more at flat or down rounds. And then I think overall too, there's been a bit of a segmentation between different sectors. So a lot of the macroeconomic environment too is driven by this crunch in the energy supply chain. And so I think there's a pretty strong recognition there that the value of solutions around critical mineral and energy security and electrification will still remain high. So I'd expect to see those sectors to be more insulated, I think, compared to some of the other ones. I think you're on mute.
Karsh, I think you're still on mute.
Oh, thanks, Colin. Yeah, always have one of those moments. There's a question, I think you did address this to a certain extent, Kim, from Adriana on the chat. How does the public versus private capital support vary depending on geography and technology vertical? But I did see a few other questions in that vein, so I was wondering if you can dive a bit deeper into that.
Yeah, it's a good question. I wish we had like a better tracker of all the public funding, which maybe down the line we'll do, because it'd be really interesting to see that breakdown and how it's overlaid with private sector funding, and whether there's a divergence and both are kind of filling individual white spaces or whether there's a convergence. I think from a technology perspective, we're seeing a lot more private sector funding willing to, especially outside of that like cohort of active climate investors, experienced climate investors, more willing to fund the types of companies they're used to, right? Like SaaS companies, recurring revenue companies, ones that are less capital intensive, that don't require 10 plus years of R&D innovation to demonstration. Even just like anecdotally talking to Rob Hansen from Monolith last week, they had to overcome at least 2 significant valleys of death that required going out to the market, talking to 200 investors, 199 of which rejected them simply because of the fact that they were, a hard tech company. And so it's really challenging, I think, for these hard tech companies, especially in that initial demonstration phase. So maybe you can raise, $50 million to fund your pilot scale demonstration from the private markets. But then to get to that, multiple hundreds of millions of dollars initial demonstration scale, initial commercial demonstration scale, that's really challenging to raise from the private markets because it's a few $100 million. It's really capital intensive, but the returns are the level of kind of like your project finance, infrastructure finance returns, where it's more steady cash flows versus really, really high upside. And it still requires a lot of that same risk of venture capital, where you never know what could go wrong. Maybe the technology has been relatively de-risked, but there's still a lot of risk around engineering and manufacturing scale up. And so that valley of death, I think, is where DOE and some of that public sector funding should be coming in. And so DOE at the end of 2021 announced their new Office of Clean Energy Demonstrations, which is specifically trying to address that valley of death in that initial commercial demonstration phase. So they've announced, $3.5 billion for direct air capture hubs, and I think like $4 billion or something for regional hydrogen hubs. And so the goal there is to identify geographic areas where that level of public funding can be significant and additional, and B, from a technology perspective, actually help scale up some of these, this cohort of companies that have now de-risked their technology and are ready to invest hundreds of millions of dollars into that first commercial project. And once that first commercial project is proven and has been operating for a few years, that's when banks and other lenders can start, believing that these technologies are bankable and kind of catalyze that private sector funding on the later end side.
Yeah, thank you. I think that really does shed light on it, Kim. I have a question for myself. So as I mentioned earlier on the call, I've recently launched a venture myself, and we're also a deep tech venture, which is one of the areas that you mentioned are a bit more affected by recent macroeconomic events. So I was wondering, for folks that are currently launching ventures or in like this early stage of their own ventures, what advice would you give them in terms of navigating the current VC space, or what would you look for in the VC space?
Yeah, I mean, I think, again, there's dry powder out there. There's funds that have announced, which I think is also what's been like really fortunate about being in climate versus some other sectors, is there are, funds whose mandate it is to invest in these sectors, and a lot of which specifically have mandates in, Fifth Wall just launched their a climate fund specifically focused on real estate decarbonization. There's other funds that are specifically focused on things like synthetic biology. Like, they all have very specific theses. So being able to identify which funds match the kind of thesis that you're trying to prove out, besides just, the overall landscape of climate funds. And then I think the second piece of this, which matters in, any type of kind of venture or macroeconomic environment, is just really continuing to make sure that, you've been able to find product market fit and being able to prove that out in the early days. So whether that looks like having LOIs or purchase order agreements from early adopters, or being able to show that there is, proven interest from customers down the line, I think that's really significant, no matter, what kind of phase of the market you're in. And is a big differentiator, I think, at the really early stage, to be able to say, we have potential customers on board, especially in some of these more kind of hard tech or deep tech sectors that require a few extra years, if not multiple years of technology innovation, to say that early on we have corporate partners who are really interested in buying this or working with us if this does pan out. In the early days when we were looking at Form Energy at EIP, I think what really stood out about them, even though they're a deep tech, hard tech company, probably one of the harder ones by any means, is we knew that there was market and corporate interest there, because we had utilities right on the other side that were saying, out of all of our 5 priorities to get to net zero by 2050, that last 20% is really long duration storage, and not just 8 to 10 hour duration storage, but seasonal storage. And so we knew that if they were able to prove out this technology, the market and the customer demand would be massive. And so we were more willing to take on that, early stage kind of hard tech initial risk. And so I think it's always like playing that ratio, right? Like risk to reward. If you can prove out the reward and prove out the kind of customer demand, then investors are more willing to take on higher risk.
Yeah, that's very insightful. Let's switch gears a bit to more the community-oriented questions. So I'll preempt a question that often comes up on these calls. Since you worked in VC before, climate VC specifically, what advice do you have for people trying to make a transition into working in VC?
Yeah, working in VC. Started a newsletter. No, I'm kidding. But or podcast. No, I think there's a lot of newsletters and podcasts now. But I think it is that in that general vein of like, VC is a really weird job where your whole job is kind of just like getting paid to learn and getting paid to like know what's going on, and being ahead of the curve and predicting the future in some shape and form. And so the more you can just like stay on top of things, whether that's, you know, writing better, whether that's having a really active Twitter presence, or you know, listening to a bunch of podcasts. I think it's really just like being top down and being able to see as things as possible. I think another differentiator in is if you can I think one of the characteristics of really great VCs is like strong opinions lose hold. And so the job of venture is always being able to be discerning and being able to be needed, have ideas slightly differentiated from how others are thinking. And I think that's where you find the most alpha and the most interesting deals is you look at things in a slightly different lens than others do and can find the best deals, develop those relationships with companies early on. So the more you can kind of differentiate on like having those strong opinions, but loosely held. So still kind of like listening and realizing, you know, you're probably not the smartest one in the room. The entrepreneur, founder, or the scientist probably is. It's kind of being that funnel of listening, hearing everything that's going on, seeing everything that's going on, and then really being able to distill, I think, opinions down that funnel. And then the other thing I think is just talking to people. It's just such a people-driven job. It's really just like talking to as many people as possible. And I think what I started to realize too towards the tail end is, sure, it's great to talk to other investors, but actually what's more meaningful is talking to the people on the ground level that are doing this. So making friends with, you know, founders or the operators that are on the ground working on these companies. They are probably the smartest ones in this space.
Excellent. There's a question from Jeff on the chat. Do you feel any technologies or sectors are underfunded?
Yeah, that's a good question. I mean, we have a chart on this that we published as well, like matching, I think, IPCC in IPCC's working group 3, they laid out the most impactful areas of climate technologies relevant to, you know, near-term emissions. And then we tied that sort of to our fund. And I think one that we continue to see a general kind of gap in funding in ecosystem restoration relevant to the amount of emissions impact it has. And the rationale for that really is because today there isn't a ton of ways to monetize ecosystem restoration besides like carbon credits, or now there's this kind of emerging field of biodiversity and ecosystem level credits, which are still in the early days. So it gets to this like mismatch between, you know, venture funding and capitalism versus like what actually benefits the climate. So that's one area. But I think there have been more solutions that are picking up there. So we saw companies like, for example, Vibrant Planet that just raised, that's developing almost like an operating system for climate monitoring and adaptation. That we're also seeing a lot more solutions and kind of conversation around how do we integrate not only, you know, carbon emissions into credits, but thinking about biodiversity impacts and how to quantify that. There's just a lot of challenges, I think, in these sectors, not only from a monetization perspective, but also from an MRV perspective. So how do we, you know, if we want to tokenize, if we want to, you know, credit these things, how do we make sure we can actually measure, quantify, report, and verify this? And that's where it gets down to the nitty gritty of like, you know, measuring soil carbon sequestration and the science of the thing, which I don't think we still have yet down, is you can only create a market if you're able to verifiably quantify the level of like emissions or the level of like biodiversity impact that it's having. And so in order to build that market, we really need to be able to flesh out how we're going to measure the thing, which I think is the kind of key barrier here.
Thank you. Thank you. And for the audience, if you have any other questions, feel free to put them into the chat. We still have 10 more minutes with Kim. I do have another question in the meantime. For folks trying to make a transition into climate work in general, how important is domain expertise for, say, people in their mid-career? And do you have any general advice for folks trying to make a transition in terms of how they should be structuring their applications or presenting themselves?
Yeah, it's a good question. I think there's a lot of this. If I weren't working at CTVC, I would want to explore this more. I think there's like actually a ton of climate expertise out there in the market today. And then there's a ton of like, Silicon level expertise of building businesses, of building good businesses. And if there's a way to like better match those two personas, I think there could be a lot of interesting companies that are launched. So to give some examples, we've been in conversations with their technology transitions, and there's all of these national labs, there's all of this, university lab, university academia, not to mention also innovation at that corporate level, where there's a lot of technology innovation just sitting on the shelves, kind of collecting dust at these large kind of industrials and corporates that have been innovated on over the last decade or so. And so there is actually a lot of technology innovation. If you just like wanted to sit down and sift through like IP and patents and papers and things like that, there's a lot that's out there, but it requires, the extra effort of knowing where to look and where to find it. And then I think on top of that too, it's being able to kind of match that, science, PhD, research level expertise with the expertise of knowing how to scale and build a business around this. So not to harp on the Rob Hansen interview over and over again, I just think it's just such an interesting kind of case study is, they didn't come up with the monolith materials out of their own lab. They did the hypothesis of, okay, we, know solar is going to get really cheap. And the second order effect of that is that hydrogen will replace a lot of the kind of fossil fuels that we're using today, because we can create that we can develop that now with really cheap renewables. And so let's go out and find different hydrogen technologies that we'd be interested in building into a company. So they went and spent a year looking for that, found this professor in France who had this, methane pyrolysis pilot all the way in the south of France. And that is now what is Monolith's business and technology. And so to some extent, it requires like knowing where to look and having, a general hypothesis on like what sector you're interested in digging into, but it doesn't necessarily require like being the scientist or the PhD level person yourself. There's a lot of already existing technology and innovation out there. And I think it's just like a matter of how we can better match those opportunities or know where to look.
Thank you. We just have a couple of questions on the chat. Maybe we can do a rapid fire style. We have a question from Kristen. Given all of the recent funding going into climate tech companies, what kind of M&A trends do you anticipate?
Yeah, that's an interesting one. How to answer this one? I think it's hard to draw like a general conclusion across all of climate tech, because each sector is so different. But I think specific areas where we've started to see a pickup in at least like smaller deal size M&A activity, always continuously to seeing that in energy. So a lot of things in EV charging and fleet management. A lot of the larger oil and gas majors are now spanning into electrification and renewables and EV charging. And so seeing things like BP acquiring Amply Power, Schneider Electric recently acquiring Opus One. And then there's also, I think, more activity in this now driven by the SEC risk disclosure around, all big corporates now have to report on their climate risk disclosures. And that also impacts, the financial institutions as well. And so I think there's going to be a lot more M&A activity there, where we've seen, the climate service get acquired by S&P. We've seen recently the International Continental Exchange acquire a climate risk player as well. So a lot more activity, I think, this kind of climate risk intelligence accounting side of things, where these larger market research and ratings providers now need to also incorporate climate risk and ESG into their repertoire. So I think that's some of the M&A activity I've seen that have started to really pick up. But that's a bit more on the in recent months, I think.
Final question for you, Kim. Some companies have gone, oh, sorry, there was a question from Kyle. What roles do you see open source software databases play specifically around MRV?
Oh, that's an interesting one. I don't have that great of an answer there. I would love for people who have more experience there to chime in, or maybe we could publish a feature on that sometime. I mean, in the Web3 wave, right? We saw a lot of really interesting concepts and protocols. I think we're still seeing that play out. For example, Open Forest Protocol has an interesting MRV concept where they're using the decentralization benefit of blockchain to be able to have people on the ground and local communities actually do that measurement and verification and cement it on the blockchain. So I think there's probably some more interesting use cases there. The challenge, I think, with open sourcing it will be, how do you standardize that quality? Because the primary challenge of MRV, I think, is like there is no standardization, especially in things like carbon removal, where what are we measuring? What counts as this is verifiable, CO2 sequestered? Is it a spectrum or is it binary? Like, I think a lot of these questions are more around what's the framework, and then it's how is this feasibly done of going out and measuring it.
Great. So unfortunately, Wayne, we won't have time to cover that question, but you can always ask it in the Work on Climate Slack, and I'm sure Kim can get back to you. I have one final question for you, Kim. Since you share so many wonderful insights with us, what can the community do to help you in your mission?
Yeah, I mean, it's still early days of myself building this out and working on CTVC full time, so it will be more to share there. But if anyone has any kind of like data science or data engineering background, there's probably more we'll be working on there. So feel free to reach out.
Thank you. And we'll make a follow-up post on the events channel in Work on Climate as well. You can ask any of your follow-up questions to Kim there. And just for those of you that are not familiar with Work on Climate, we're a nonprofit focused on making climate work mainstream, and you can join us at workonclimate.org. And we have gotten this far as an all-volunteer organization, but we are fundraising to hire full-time staff. So if you're interested in supporting our mission, you can make a donation at workonclimate.org/donate, or you can reach out to our executive director at eugene@workonclimate.org. So if everybody that's able to unmute can just unmute and say a big thank you to Kim on 3, that would be very appreciated. So 3, 2, 1. Thank you, Kim.
Thank you.
Thank you.
Thank you.
Thank you, Kim. Thanks, guys.
Good night.